Today, we're jumping into something that, well, I think pretty much everyone wonders about at some point. When should I actually start investing my money?
Right. The huge question.
Yeah, and there's so much uncertainty around it, isn't there? Like, do you wait till all your debt's gone? Do you have to start super young? What if you only have a tiny bit saved?
Exactly. These are totally normal things to wonder about. And honestly, the answer really matters. The
Yeah.
timing here. It can genuinely be the difference between just, getting by financially and actually thriving long term.
Okay, so timing holds a lot of power then.
Immense power.
So let's break that down. When we say investing, what do we really mean? I usually think of it as like making your money work for you so it grows, instead of you just trading your hours for cash.
That's a great way to put it. Yeah. Putting money into things like stocks, maybe real estate, or even a business. It's about growth over time.
Right.
And that idea, money working for you, it leads straight to the sort of fundamental rule here.
Yeah.
The absolute best time to start investing is, well, it's as early as you possibly can.
Okay, as early as possible. Why? Why is starting early so critical? What's the mechanism there? I hear compound interest mentioned a lot.
Compound interest, yes. That's basically the magic ingredient, the engine for building wealth over the long haul. It's not just your initial money-earning returns. It's those returns also starting to earn returns. And then those returns earn returns. It snowballs.
So it kind of builds on itself exponentially.
Precisely. Think of like a snowball rolling down a really long hill. The longer it rolls, the bigger it gets, faster and faster.
Yeah.
Time is the hill in this analogy, a really, really long hill.
That compounding effect sounds incredibly powerful. But okay, before everyone rushes out, there's a really important practical question, isn't there? Just because you can start investing, does that automatically mean you should right now? Are there prerequisites?
That's a super important distinction.
Yeah.
Before you jump in, there's kind of this readiness checklist you should run through.
Yeah.
First thing, absolutely essential. Do you have an emergency fund?
Right, the safety net. How much are we talking about there? What's the standard advice?
Generally, you want at least 3 to 6 months worth of your essential living expenses tucked away somewhere safe and accessible.
Okay, 3 to 6 months.
Yeah, and this isn't just like a nice to have, it's your buffer. Life happens, right? Job loss, car breaks down, unexpected medical bill. You absolutely do not want to be forced to sell your investments when the market might be down just to cover basics. That can really hurt.
That makes total sense. Okay, so emergency fund first. What's next on the checklist? High interest debt, stuff like credit cards.
Exactly. If you're carrying debt, especially like credit card debt, that's charging you, say, 20% interest or even more. Well, that debt is costing you a fortune.
More than you'd likely make investing, right?
Almost certainly, yeah. Think about it, paying off a 20% interest debt. That's like getting a guaranteed 20% return on your money. You can't really beat that reliably in the market.
Wow. Okay, so tackling that high interest debt should probably come before investing most of the time.
For sure. It's often the smartest financial move you can make. Get rid of that massive drag first.
Got it. And the third point, financial stability, like knowing your income is steady and you're not scraping by each month.
Yeah, basically.
Yeah.
Is your income reasonably stable? Are your basic bills covered comfortably? Are you not living paycheck to paycheck? If you can say yes to those, you're generally in a pretty good position to start thinking about investing. You're building on a solid foundation.
Okay, foundation first. Emergency fund, high interest debt handled, stable basics. Once that's sorted, then the power of starting early really comes into play.
Absolutely. And there's a classic example that illustrates this so clearly.
The Anna and Ben story. I think I know this one. Let's walk through it. So Anna starts investing, let's say $200 a month. She starts young at age 25.
Right. And she keeps this up for 10 years until she's 35. Then she stops contributing completely. So 10 years of investing.
Okay. Then there's Ben. He also invests $200 a month, but he waits. He doesn't start until he's 35.
And he's diligent. He keeps investing that $200 every month until he retires at age 65. So Ben invests for a full 30 years, 3 times longer than Anna.
So Anna invests for 10 years, Ben for 30 years, same amount each month. You'd think Ben would end up with way more, right?
You'd absolutely think so. But the surprising outcome, assuming the same average rate of return for both, is that Anna actually ends up with more money.
Wow. Even though she stopped contributing 30 years earlier.
Exactly. Because her money, the smaller amount she initially invested, had 30 extra years to just sit there and compound. Time did the heavy lifting for her. It's all about that early start, giving the snowball more hill to roll down.
That's incredible. It really shows the cost of waiting, doesn't it?
It really does. Anna invested less money overall, $24,000 versus Ben's $72,000, but her early start made all the difference. Waiting until you feel perfectly ready or comfortable can literally cost you decades of growth. It's this invisible penalty for delaying.
And it underlines that you don't need a fortune to start. Even something small, like you mentioned, $50 a month, over decades, that can really grow into something significant.
Absolutely. Tens of thousands, potentially. Consistency and time are the key ingredients, much more than the initial amount sometimes.
So thinking practically then, what are some of those moments in life, those kind of green lights, that should really signal to someone, okay, now might be a really good time to start investing?
That's a great question. There are definitely some key triggers. One obvious one is landing your first proper, steady job.
Even if it's not like a high-paying career job right away?
Yet, even part-time or entry level. The main thing is starting the habit as soon as you have some regular income, even if it's just a small amount. Get the ball rolling.
Okay. What else? Employer retirement plans, like a 401k.
Oh, absolutely. If your employer offers a 401k or similar plan, especially if they offer a match, that's basically free money.
Explain the match part. Why is that so crucial?
Well, often an employer will match your contributions up to a certain percentage of your salary. Like they might put in 50 cents for every dollar you contribute, up to maybe 6% of your pay.
So it's an instant return on your investment.
Exactly. A 50% or even 100% guaranteed return on whatever you put in to get the full match. You should always try to contribute enough to get the full match if you possibly can. Not doing so is just leaving money on the table. Serious money over time.
Right. Free money is hard to argue with.
Yeah.
Okay, what about getting a raise?
Perfect opportunity. When you get a raise, it's tempting to just let your spending creep up to match it, right? Lifestyle inflation?
Mm-hmm. Happens easily.
But a smarter move. Take at least a portion of that raise and automatically increase your investment contribution. You were living okay without that extra money before, so funneling some or all of it into investments is a relatively painless way to boost your future wealth.
That's clever.
Yeah.
You don't miss what you didn't really have in your budget yet. What about paying off debt, like finishing a car payment?
Another great trigger. Once that car payment or student loan payment or whatever it was is finally gone, you've suddenly got that cash flow freed up each month.
Yeah.
Don't just let it get absorbed into random spending. Take that exact amount you were paying on the debt and redirect it straight into your investment account. You're already used to that money leaving your account.
So you just swap the debt payment for an investment contribution? Simple.
Super simple, super effective. And finally, maybe a bit broader, but just starting to seriously think about long-term goals.
Like buying a house someday, retiring early, traveling.
Exactly. When those big future dreams start to feel more real, that's often a powerful motivator. Investing is the tool, really, that helps turn those distant goals into something achievable. It connects today's saving actions to tomorrow's possibilities.
Okay, so let's say the green lights are on. Someone's got their emergency fund, they've handled bad debt, they have steady income, and they're motivated. Where do they actually start? What are the simple options for beginners? It can seem intimidating.
Totally understandable. But the good news is, you don't need to be Warren Buffett overnight. There are some really accessible starting points.
Like with the 401k we mentioned.
Definitely start there if you have one, especially for that match. It's often the easiest place to begin. Beyond that, you've got IRAs, individual retirement arrangements.
Roth IRA, traditional IRA. What's the quick difference?
So basically it comes down to taxes. With a Roth IRA, you put in money you've already paid taxes on, but then your qualified withdrawals in retirement are tax-free.
Okay, tax-free later.
With a traditional IRA, you might get a tax deduction now for your contributions, but you'll pay income tax on the withdrawals in retirement.
Tax break now, pay taxes later.
Right. The choice kind of depends on whether you think you'll be in a higher or lower tax bracket now versus in retirement. But both are great tools for long-term growth.
Got it. What about options for people who don't want to pick individual stocks? That feels risky to a lot of beginners.
Yeah, and for good reason. Picking stocks is hard. That's where index funds or ETFs, exchange-traded funds, come in. They're fantastic for beginners.
Why is that?
Because they hold lots of different stocks, or sometimes bonds, all bundled together. So buying one share of an S&P 500 index fund, for example, gives you a tiny piece of 500 large U.S. companies.
Ah, so it's automatically diversified, spreads out the risk.
Exactly. Lower risk, generally lower cost, and you're essentially betting on the market as a whole rather than trying to find the one winning needle in the haystack. Perfect for getting started.
Okay, that sounds appealing. And what if someone wants it even simpler? like totally hands-off.
Then robo-advisors might be the answer. These are online platforms that use algorithms to build and manage a diversified portfolio for you based on your goals and risk tolerance.
So you just answer some questions, deposit money, and it does the rest.
Pretty much, yeah. It handles the balancing, the investing. It's designed for simplicity and automation. Great for people who really don't want to deal with the day-to-day decisions.
Okay, lots of accessible options. But just as important as knowing when to start, are there times when you should definitely pause? Or maybe not start yet? Some red flags.
Oh, absolutely. Crucial warnings to heed.
Mm-hmm.
Number one, big flashing red light. Never, ever use a credit card to invest.
Right. You mentioned the interest cost earlier. It just doesn't make sense mathematically.
Not at all.
Oh,
The interest you'll pay on the credit card debt will almost certainly swamp any potential investment gains. It's like digging a hole while trying to build a hill. Plus, it kind of signals you might not actually have the funds to invest responsibly right now if you're resorting to borrowing at high rates.
good point. What's another warning sign?
Not understanding what you're actually investing in. If someone pitches you something, or you read about some hot stock, but you genuinely don't grasp what the company does, how it makes money, or why you think it will grow,
Yeah.
step back.
So avoid the black box investments.
Definitely. Investing in things you don't understand is closer to gambling. And when the market inevitably gets choppy, you're much more likely to panic and sell at the wrong time if you don't have real conviction based on understanding. Informed decisions are key.
Makes sense. And back to basics. No emergency fund.
Still a hard stop.
I
Yeah.
see.
We keep coming back to it because it's foundational. Build that safety net first.
Yep.
Investing comes after financial security,
Mm.
not before.
Got it. Any other reasons to pause? What about shaky finances?
Yeah, if your month-to-month income or expenses are really unpredictable, if you're not sure you can consistently put money aside without stressing yourself out, it's probably better to focus on stabilizing your budget first.
Right.
Investing should ideally build wealth and reduce financial anxiety over the long term, not add more stress in the short term because you're overextended or worried about needing the money back immediately. Get the basics solid.
Okay, that's really clear. So pulling this all together then, the core message seems to be, get your financial foundation stable, first emergency fund, high interest debt tackled, basic budget sorted. Mm-hmm.
And then start investing as soon as you can after that. And the earlier you start, the better, because of that compounding magic.
That's pretty much the heart of it.
Yeah.
And crucially, you don't need to be rich to do this.
Right. Small amounts count.
And you don't need to be some Wall Street guru either. Start simple, start small, but the most important thing is just to start.
Because it seems like the biggest regret people have isn't usually about picking the wrong investment.
Rarely, yeah. More often than not, the biggest regret you hear is simply, I wish I'd started sooner. They look back at the years they waited and think about the growth they missed out on.
That's powerful. Waiting too long is the common mistake.
It really seems to be.
So maybe a final thought then for everyone listening,
Mm.
a question to reflect on.
Mm-hmm.
If you're not investing already, what's actually stopping you right now?
Yeah, what's the barrier? Is it fear, lack of knowledge, feeling like you don't have enough? Maybe just think about what that very first small step could look like for you.